Hey everyone, it's time for another episode of Mayhem in the Markets, brought to you by Traderade and coming to you Sunday, January 22nd, 2023. Who's left to buy as inflows surge? We can see the highest inflows in investment grade, high yield, and emerging market debt, as well as equity funds since the summer of 2020. And this is on the back of folks still having near record amounts of their net worth in the US allocated into the equity market. So everyone's still pretty long. We haven't had that moment where folks started to really cash out, which is one of the things we typically look for a discernible bottom. We also see that valuations remain quite elevated. The Shiller PE is 29, with average being around 17. The Fed's still tightening, and these bottoms don't tend to happen until the Fed's not only pivoted, but is meaningfully easing. We also haven't seen a recession, and most bear market bottoms happen during a recession. So it looks to me like positioning is starting to get a bit stretched again. Obviously, that doesn't mean we're going to see some kind of imminent collapse, but it does mean that perhaps we're starting to see some of that so-called dry powder on the sidelines be expended. And look, folks, I don't want to be bearish any more than anyone else, but I am looking for signs that I feel that the risk-reward ratio is in my favor. So in environments like this, I run a long-short portfolio. I like to be long areas of the market that show relative strength and short areas of the market that show relative weakness, so I can have a relatively delta neutral approach to the market, not necessarily trying to be guessing where the next path is going to be for the broader market, but instead looking at areas of the market where institutions are rotating out for shorts and where they're rotating in for longs. And I find that that is a strategy that works well in the mid to late cycle bear when things start to get very volatile. Short-dated S&P 500 index options volume has reached 50% for options that are expiring in 6.5 hours or less. This is a tail that wags the dog phenomenon. There's no doubt that when we see these enormous amounts of options activity in the biggest options market in the world, the S&P 500 index, it has a discernible impact. There's about $1 trillion of premium that exchanges hands every day for these index options, whether it's S&P, NASDAQ, Russell, or some of the associated ETFs. And of that, we can guesstimate that about 250 to 300 billion of that volume is going into these zero DTEs, these lottos, these options that are expiring the same day. This can move the market. And when it does, it can create pockets of hot air. You recall last year we saw, the sort of demise of Tesla. But before that, in 2021, it was one of the most commonly bought options on the call side almost every single day. We also saw those delta squeezes in firms like Affirm, Asana, Cloudflare, and Upstart. And all of them had these parabolic rises that didn't really make any sense until you started to look at the options, and then you could see it. And when these squeezes, these delta squeezes end, they end poorly. So if we see the whole stock market, a $10 trillion index, being delta squeezed, it does start to concern me, particularly because there's no reason folks can't put this on the put side and get into a squeeze that sends the market meaningfully lower as well. But for now, we're seeing this as a routine phenomenon. It's happening regularly. It happened last Friday and even the Friday before. And I think that that's something that we need to be paying attention to because of the structural vulnerability that it could create. We could get a situation where those folks decide, again, they could take it the other way, or they could just stop participating. And, this is having such an outsized impact on price discovery that we can't discount it at the index level or in some of the single stocks that are getting both call and put delta squeezed. The consumer's not doing so well with the personal savings rate closing in on a 70-year low. And this is something that suggests the level of stress that consumers are experiencing is rather high, especially as credit card debt is surging. And while I know the excess savings rate is rather high, particularly for the wealthier groups, this picture is one where people simply do not have the cash on the sidelines to make purchases, because not only are they not saving, but they're also using credit cards or revolving debt with rising interest rates to make a lot of purchases. Now, obviously, there's exceptions to this rule, particularly the top 10% of income earners. But for the majority of Americans, 2/3 are living paycheck to paycheck. They're using credit cards to pay for food, rent, utilities. And this is in an economy where 67% of GDP is driven by consumer demand. So when we do the math, it paints a picture that's a little concerning because we're not even in an official recession yet, and we're already starting to see this kind of vulnerability. And it shows us in credit card delinquency rates as well that consumers are not particularly happy, particularly the first quartile. You could see that delinquency rate is rising. The others are beginning to rise as well. But what this paints for us is a picture of people are already showing stress before we see a recessionary environment. What is it going to be like when more people lose their jobs, when rates continue to rise and the money supply continues to shrink? There's simply not enough money to go around for everyone to be able to pay their bills or the interest on their debt. That interest, if you think about it, is new money that didn't exist before. It has to come from somewhere. And with a historically shrinking money supply, one that has never shrunk as much as it has, or at least not in 4 decades, as far as the chart goes back, this suggests that there's not enough money to pay down this debt, particularly the higher interest debt in the financial system. So I do think that this is something to be concerned about. And while the delinquency rates are low for now, this change in trend is one to be concerned about, particularly if it continues. Cancellations are surging for home builders, another sign that the housing market has overheated. We saw a 68% cancellation rate in Q4 2022 for KB Homes. This is versus 13% the prior year. And quite frankly, there's just too much supply out there. We haven't quite seen that manifest itself yet, but we will. And I say that because we have institutions that have bought many, many homes, multifamily and single family units, but we also have individual investors that have bought homes for Airbnbs, for rentals, for their own vacation property. A lot of that supply is likely to be released into the market by motivated sellers. And home buyers have seen the prices at which they're selling homes drop quarter over quarter. They've seen higher cancellation rates on both new orders and backlog. And this is a situation that suggests that not only are they going to have less orders in the year ahead, but the orders they've already have on the books are going to shrink as well. Combine that with their cost of capital rising, and they do tend to run a fair amount of revolving debt, and that's not a great picture for the sector or the real estate market that's 15 to 18% of the U.S. economy. And we can see existing home sales are collapsing to the lowest since 2010, when we were still dealing with the sort of end game of the great financial crisis. The housing market took quite some time to fully recover, and we're showing signs that homeowners are just not wanting to buy a new home. Prospective homeowners are less willing to step up, with homebuyer sentiment remaining near historic lows. And the cost of homeownership has doubled since the beginning of COVID. So can you blame them? But the real kicker is that 50% of millennials were living with their families at the start of COVID. Now they're even further priced out of homeownership as the cost has doubled. These are folks who are in the prime home buying years of their life. And you've got other older people who are retiring, who are downsizing, moving into assisted living, or, sad as it is to say, dying. And that supply is being released in the market, and there isn't the demand from these younger generations to absorb it. That's a problem that's structural, that's demographic driven, and it's one that's likely to continue to grow unless and until we see prices and rates drop. And maybe we will over the years ahead, but I think this is something that will play out in 2023 and beyond. And this year alone, we could see double-digit drops in home prices as a result. And danger signs in private REITs are growing. Investors seek to pull $20 billion from core real estate funds. This is commercial real estate, and this is another side of the same situation. Now think about it. After COVID, a lot of people didn't go back to commercial office spaces, right? Why would they? A lot of people were able to do hybrid work. And while we're seeing some folks return this year because the companies are demanding that they do so, at the end of the day, we're not in a situation where this is anywhere near resolved. The work from home or hybrid work paradigm is here to stay for a lot of companies, and we're probably going to see office space utilization change as a result, because if you have folks working on a rotation, you need about 2/3 or half or even 1/3 of the amount of commercial square footage that you used to. And if your company is hiring all remote, you don't need any commercial space really. So the paradigm for commercial office utilization is likely to be one that remains subdued. We also see less and less retail stores thriving. When we went into the great financial crisis many moons ago, we had about 600% more retail square footage than any other country on earth. Well, we've shrunk that since, but we still have some more room to go. There's still some more pain in brick and mortar retail, both because of e-commerce, but also because we're no longer in an era of lower and lower rates where people can buy beyond their means to spend money they don't have to impress people they don't even like. Some of these paradigms of debt-driven overconsumption are beginning to change at a societal level, particularly for the lower income earning groups. And I think that that's something that will also have a negative impact on commercial real estate in the years ahead. We can see that there's a clear signal for industrial production declines and a U.S. recession in 2023, as we have leading indicators showing us that we're getting into a contraction, and these contractions tend to lead towards recessions. So why does that matter? Because we're likely to see a recession this year. We've got extremely inverted yield curves, whether it's the 3-month to 10-year or the 2-year to 10-year. They're really all over the yield curve. And these have a pretty high probabilistic outcome of leading to a recession within 12 to 24 months. And so these yield curves are also inverted both quite deeply and for a long period of time, which typically prefaces a rather nasty recession. Now, obviously, past is not prologue, but these are trends that have been pretty consistent. I want to say for the last 10 of 11 recessions, they've been predicted by yield curve inversion. So this is something that I believe we should take as a warning signal, because we're seeing it in the economic data, in these leading indicators as well. There's multiple points of convergence where this data coalesces and paints the same picture, one where an economic contraction becomes more likely. And we can see it in the Empire State Manufacturing Index, which is collapsing. Not a good sign at all. New York is a really, really big hub. There's so much industrial activity that happens in the state. It's interconnected with the rest of the world. And when you start to see their Empire State Manufacturing Index contract, it also tends to be a leading indicator towards a recession. And speaking of yield curve inversions, here's that 10-year minus 3-month inversion. It has reliably led to other recessions, but here's the kicker, folks. It's not when it's inverted. The inversion's like the yellow light. It's when it starts to steepen out of the inversion that you get that red light warning signal that recession is imminent. And so the longer we stay inverted and the deeper we go, as we steepen out of that, it's likely that we see a nastier, deeper recessionary environment. So again, past is not prologue. Anything can happen. I don't have a crystal ball any more than you or the Fed or anyone else. But what I can say is this has been a pretty darn reliable signal, and you can see it on the chart going back for some time here. And hedge funds and really overall market participants are very short the dollar. They're also quite long the euro here. Now, this is not a situation that I think is going to resolve any differently than it has in the past. That is to say, when people get all on one side of the boat tends to topple over. Everyone's short dollars and long euros. That tells me that probably the play is to long dollars and short euros. Now, that's not trading or investment advice. That's just an idea because of this stretched positioning and how it will likely revert to something more normalized. And when it does, these exchange rates could change in favor of the dollar and against the euro. Apple is heavily reliant on the iPhone refresh cycle. You can see it is such an important part of their revenue. It is indeed a runaway success story. The iPad, while impressive, is nowhere near where the iPhone has achieved in terms of the number of units sold. And look, when we're getting into a situation where the world is headed towards a potential recession, where inflation is changing demand, the iPhone is ultimately an important purchase, but maybe the rate at which we replace them changes. Maybe people don't need to buy them quite as often. And if that's the case, then hey, that could have a negative impact on Apple, who's also heavily reliant on China, and there's more and more potential for disruption in that relationship. Nevertheless, Apple's earnings are coming up soon. We should pay very close attention to them as they do. We'll get some more ideas as to how their last quarter did, particularly during that crucial holiday shopping season, and what they're expecting for the quarter ahead. One interesting sign is they've released these new MacBooks and M2 processors in the first quarter of this year, and some speculate it is to try to boost that first quarter. If the market were to bottom here, it'd be the most expensive new bull market in history. At least that's what the data says. And I believe it. We are seeing valuations here that are awfully stretched. And I know some folks will say, oh, but why aren't you looking at forward PE? Well, that's an estimate. We're looking at historical PE. And we can see that really forward PE is not looking better. With the types of contractions in earnings, we could see up to a 5% drop in S&P earnings this quarter. So that's not going to paint a better picture when the E is dropping. the ratio goes higher, right? When you have less earnings and price stays the same, PE goes higher. So when you're looking at PE, you've got to consider that what we may see throughout earnings could suggest that some of these companies are actually doing worse. And look, everyone wants to see disinflation or deflation. If you go to the store and you buy things, food, energy, anything, we want to see the rate at which prices are rising slow, if not prices themselves drop, right? That's not going to be good for corporate earnings. And that's something that I think we have to take into consideration as we navigate through earnings season. That this could create more pressure on the bottom line for a number of different companies. The ones that particularly don't have a lot of pricing power, when price goes against them, they have to drop and they could see margin compression. And remember, central banks kind of are the market, right? Look at this chart. What do you see? In blue, the total assets of the Fed, the European Central Bank, and the Bank of Japan, and in red, the S&P 500. And there's a pretty strong positive correlation here. And I know folks will go back and forth on this and say, oh, it matters, oh, it doesn't matter. I think it matters. Here's why. Because when the world is being flooded with easy money, when liquidity is buoyant, risk assets have a nice bid. And it's easy when there's an environment of financial repression, when the real risk-free rate of return is negative or flat, you're going to be looking at risk to get that return or any return you can, which means more demand for stocks. And on the other side of it, when you're tightening, when rates are going up, when the real risk-free rate of return is on the rise, when you can finally get a decent yield from short-dated treasuries or AAA corporate debt, why would you stay in stocks, especially if you're a 50, 60, or 70-something plus saver, where you have had so many years where you couldn't get a yield on anything, and now you finally can, and you don't have to be involved in the choppy volatility of the market. So I could see some folks saying, you know what? I don't want to be in stocks anymore after this wild ride. But the other thing is the Fed and other central banks are not done with quantitative tightening, not by a long shot. Unless they break something big, they're going to continue down this path unless and until they see inflation get to around 2% PCE for the Fed, right? Well, we're probably nowhere near that, and we've heard economists like Mohamed El-Erian even say inflation could stay sticky around 4% and cause central banks to have to stay tighter or higher for longer, a mantra we've heard from the Fed and even the ECB of late. And I think that matters a great deal because that could have a deleterious impact not only on stock market price discovery to the downside, but also corporate earnings and the availability of capital for a lot of companies that simply don't make money or don't make enough money to service their debt at higher levels. So this is all important to consider, and I would say that the aggregate amount of central bank liquidity in the financial system does have an outsized impact on price discovery for all manner of assets, but especially risk assets like stocks. And so a soft landing still seems unlikely to me. I know it's the talk of the town, right? We've heard it from Fed speakers, we've heard it from media personalities, we've heard it on social media. And it's funny because this narrative seems to also exist in parallel with the narrative that the Fed's going to pivot imminently. Now, one of these things is not like the other. One of these things is just not the same. Because if we have a soft landing, why does the Fed need to pivot? What motivation would there possibly be for them to say, you know what, everything's going really well with higher rates, we should cut rates? Why? They don't need to. If they can keep rates higher, that's actually good for the economy if the economy can survive it. But the reality is the economy probably can't. The debt burden of the U.S. government is going to lead to about $700 billion of interest service per year. And as QE completely stops, as the Fed rolls off its balance sheet, right, and the effects of QE are shrunk, that changes the paradigm for the Treasury. Think about it this way. For all the debt that the Fed holds from the Treasury, it takes its expenses, it nets them out, and it pays the difference to the Treasury at the end of every year. So it's almost like the Treasury had this sort of interest-free credit card with the Fed. That's going away. And in its place, interest rates have risen remarkably. The liabilities of the U.S. government continue to rise. Now we have another debt ceiling kabuki theater debacle that's playing out in the hallowed walls and halls of Congress, right? It's not a good thing that neither party, that no one in power can seem to reconcile a budget, can seem to try to lead the country in a direction where there's anything resembling fiscal prudence. And this will catch up to us in time. But for now, it makes it much less likely that there's going to be a soft landing because the Fed is continuing to tighten. The legislature is fighting the Fed with their demand construction acts like the CHIPS Act, like the ironically named Inflation Reduction Act. Those are not good things for a Fed that's trying to destroy demand and not getting any help on the supply side. Meanwhile, states and other countries are issuing inflation relief checks. And you've got China reopening, which is the second wealthiest chunk of consumers on earth, the largest middle class of over 700 million people. They've got 750 billion of yuan equivalent reserves in their bank accounts. And this is a country that's the largest user of raw materials and energy on the planet. So if they really do come back online in a meaningful way, it's more essentially the antithesis of what the Fed wants to see because it stimulates global demand in a resource-constrained world. So I want to thank everyone for tuning in. If you're interested in what I have to say about the markets and the economy, if you'd like to learn more from myself and our team, you can join Traderade today with 20% off from me using the code Mayhem20. Just go to Traderade.com, check out our plans, figure out the plan that works best for you, and you'll get 20% off the first month of a monthly plan or the first year of a yearly plan using the code Mayhem20. So thanks everyone for tuning in. I hope you enjoyed this episode of Mayhem in the Markets, and I will catch you next time.